Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a specific spotlight on a company that's popped up on our screener, Mask, which is 3E Network Technology Group Limited. This stock is showing some truly eye-popping cost-to-borrow fees, and we're going to break down exactly what that means and why it might be relevant. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's get acquainted with Mask, or 3E Network Technology Group Limited. This company operates in the technology/software application sector with a current market cap sitting around $6.02 million. They specialize in business-to-business ID solutions, primarily for companies in the People's Republic of China. Their offerings include smart property and restaurant management software systems, along with clean energy-related software. It's a relatively small player in a big industry, but its recent activity in the borrow market is anything but small. What is cost to borrow and why it matters? Before we get into the specifics of Mask, let's quickly explain what cost to borrow means, especially for our newer viewers. When you short a stock, you're essentially borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price to return them. You pocket the difference. But borrowing isn't free. The stock lender charges a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. When a stock becomes hard to borrow, it means there are very few shares available to lend out, and the demand from short sellers is high. This scarcity drives the CTB fee sky high, sometimes well over 100% per year, like we're seeing with Mask. Think of it like renting a car. If there are only a few luxury cars left, and everyone wants one, the rental fee goes through the roof. Why this stock is hard to borrow right now. Now let's talk about Mask specifically. Why did it appear on our hard to borrow screener? The numbers speak volumes. The current cost to borrow fee for Mask is an astonishing 852.2% annualized. Show graphic, 852.2% CTB. That's not a typo. To put that in perspective, that means short sellers are paying over 8.5 times the value of their shares per year just to hold their short position. Even more compelling is the momentum behind this fee. It has surged by plus 222 percentage points over just the last 5 trading days. This indicates rapidly increasing demand to short Mask, or a rapidly shrinking supply of shares available to lend, or both. Currently, there are only about 150,000 shares of Mask available to borrow against an estimated float of just 0.8 million shares. A small float and low borrowable shares can create a very tight squeeze dynamic. Our internal composite squeeze score for Mask is 52.0, which indicates a moderate but notable setup. Squeeze mechanics explained. So, how does a high cost to borrow relate to a short squeeze? It's all about supply and demand. When short sellers are paying an exorbitant fee like 852.2% on Mask, that cost eats into their potential profits every single day. If the stock price starts to move against them, meaning it goes up instead of down, they face a double whammy: losses on their position and those sky-high borrow fees. This pressure can force short sellers to close their positions. To close a short position, you have to buy back the shares you borrowed. If many short sellers are forced to buy back at the same time, it creates a surge in buying demand, which can rapidly drive the stock price even higher. This upward pressure can then trigger more short sellers to cover, creating a cascading effect known as a short squeeze. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price. This can completely offset or even negate a short squeeze thesis, even if the cost to borrow is extremely high. For Mask, we've checked for recent dilutive SEC filings like -1s, -3s, or 424 BS in the last 90 days, and we found no recent dilutive SEC filings. Additionally, we found no recent reverse split for Mask in our look-back window, which can sometimes precede or be associated with dilutive events. So, based on this, the immediate dilution risk appears low for Mask. Again, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very strong conviction that the stock price is headed lower, and they are willing to pay a premium to maintain their short position. Always conduct your own thorough due diligence. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For Mask, what should we be looking at? The stock closed today down minus 3.96%, and over the last 5 days, it's down minus 1.52%. However, looking back 30 days, Mask is up plus 3.74%. Today's volume was 103,900 shares, which is significantly lower than its 30-day average volume of 8,555,846 shares. In fact, today's relative volume is practically Xerox average. Low volume can sometimes make a stock more susceptible to sharp moves if buying pressure suddenly increases. Keep an eye on the cost to borrow continuing its upward trend, any further reduction in shares available to borrow, and any significant increase in trading volume as potential indicators. Mask, or 3E Network Technology Group Limited, presents a compelling case study for a hard-to-borrow stock with its astronomical 852.2% cost-to-borrow fee and a very tight share supply. While the setup for a potential short squeeze is present, remember that the market is unpredictable, and high CTB does not guarantee any specific outcome. Stay informed, stay vigilant, and always manage your risk. If you found this breakdown helpful, please smash that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments below what other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.